intensive economy today than we were 40 years ago. And so we're more resilient when it comes to triple-digit oil prices than we were in the 70s.
Great point. Peter Schiff from Euro Pacific Capital joins us. Peter, you don't have to go back to the 70s. I went back to 2008 when we saw that huge spike in oil up to $140 a barrel in 3 months. It was down below $40 a barrel. That was entirely a monetary phenomenon. That is, it was the Fed first printing too much money and then getting too tight. Is that what's happening now?
Well, absolutely. First of all, that last point wasn't a great point. I would argue that we're more dependent than ever on oil. We have to import so much of it with dollars that we export. But there is only one reason that the price of oil is going up, that the price of gasoline is going up here in the United States. And that's because the Federal Reserve has to print a lot of money to monetize all these budget deficits and to keep interest rates artificially low. The result of that is that oil prices are rising. And it's a global phenomenon because, remember, we export our dollars all around the world, and so foreign central banks buy them by printing their own money. So this is all monetary driven. It's our fault. There is nobody else to blame. It's not the fault of Iran. It is a tax. We are paying higher gasoline prices because we have lower payroll taxes. This is how we are financing government. They're not taking our purchasing power through taxation. They're taking it through inflation. And it's not just oil prices. Americans are going to have to get used to a much higher cost of living. The price of everything is going to go up, and it's going to go sky high.
John Brady, Peter is right on certainly an important point, and that is, if you look at fundamentals, let's give people some hard facts about oil and gasoline right now. Our inventories for gasoline are at multi-year highs. People are using less of it. If supply is up, the price should have come down. What are the traders saying in the pits?
Well, I think one of the concerns that we may forget is that it's not so much the oil that we import from the Middle East, Liz. It's what our trading partners import from the Middle East, Germany and Japan. And if there's some type of shock to the global oil markets, it's global trade that's really going to suffer. I do agree with Peter's points as it regards monetary policy and the debasing of the dollar lending itself to this artificially high rate. And I think that probably will continue, as there were more murmurs in the pits this week about the Fed perhaps adding additional chapters to this whole idea of quantitative easing and Operation Twist. But keep in mind, too, it's our trading partners, Germany and Japan specifically, that really rely on that Middle Eastern oil.
Right, Pat, I still think Pat made an excellent point about oil because we are less energy dependent. Yes, he did. But we're moving on, Peter. We're moving on. We're moving on to David, look at all the imports that we, ladies and gentlemen, we have a lot to cover here, and we want to give our investors out there the best opportunity to buy what's important. And Pat Dorsey, I'm going back to you as we do head, some people say, towards Dow 13,000. Whether or not that's an important number or not, the point is that equities are still very well valued compared to bonds, are they not?
Yeah, I mean, you think about the 10-year Treasury at 2%. In equity terms, that's 50 times earnings. Or you compare a 2% yield for bonds with a 7% earnings yield for equities right now across the board. And of course, that equity income stream grows over time. Bonds are fixed. That's why it's called fixed income. So you tell me which is cheaper, a 7% yield that grows over time or a 2% yield that doesn't budge?
Equities.
Peter, I mean, you're certainly buying equities, just not necessarily U.S.-centric, right?
Well, no. I mean, I'm buying the commodities. We own a lot of oil. We own a lot of oil stocks. We own a lot of gold and silver. In terms of gold and silver, gasoline is actually getting cheaper right now. It's not getting more expensive. So that shows you it's inflation. But we're buying stocks all around the world. I particularly like to buy stocks in a lot of the Asian economies because that's where the consumers are going to be getting wealthier. They're the ones that are going to be buying all the stuff that Americans can no longer afford. So you want to own companies that are going to benefit from the growth abroad, not the ones that are going to suffer from the decline here at home.
John, how much do the guys in the pits really think about the numbers? I mean, I know you're not a big fan. Nobody's a big fan of Dow because I think it's a smaller index. S&P is a large one, much more important. But how much do these numbers play into trades?
Well, I think the 13,000 number at this level, David's been rather large. And it's really large from a psychological perspective, and specifically for the retail investor. Recall in 2011, calendar year 2011, we sort of challenged the 13,000 level 3 times, only to fail at 12,900, 12,850. So getting above 13,000 is a sign of progress. It's a little bit of an emotional rescue, so to say, for an investor class that's been beaten up over the last 7-8 years. So psychologically, it's important. What the real race now is for traders in the pit is to see how quickly it takes to go from 13,000 to 14,000. And with monetary policy as easy as it is, and with the relative value in equities as compared to fixed income, it may be sooner than you think.
Mm-hmm. Well, it could be moot as well, gang, if Europe matters. And let's throw it out to you, the money guys. Does Europe matter, Pat?
Well, I think a lot of nastiness is